and welcome to this month's market update. September was another difficult month for financial markets. Ongoing official cash rate rises combined with sticky inflationary data, moderating growth outlook and a difficult geopolitical backdrop resulted in a big fall in both equity and bond markets over September. And investors really sought the safe haven of the US dollar, which had one of its strongest periods over the month. It was up over 6.5% against the Australian dollar, and as I said, US dollar index was up to its highest level in over 20 years throughout September. Over the month, we saw both the US Federal Reserve as well as the ECB increase official cash rates by 0.75%, so 75 basis points. While domestically, the RBA also increased the official cash rate by 0.5%, taking the cash rate to 2.35% by the end of September. And as we sit here through the early part of October, we've increased cash rates by a further 0.25%, so 2.6% is now the official cash rate here domestically. And that's an increase of 2.5% since April, so a significant uptick in official cash rates here domestically. We expect the domestic cash rate to be around about 2.85% by the end of the calendar year, so a further 0.25% rate rise by the RBA, with a forecast peak terminal rate of around about 3.5%, and we think that to be reached somewhere through the middle part of next year. Certainly, if inflationary data continues to remain elevated, it could move higher than that, but as I said, from our perspective, we see the cash rate peaking at around about 3.5%. The move by central banks and the hawkish approach to future cash rate rises, particularly when we think about the US Fed and its comments, really has had a significant negative impact on bond markets, and that's resulted in the big sell-off that we've seen in bond markets throughout the course of 2022, and certainly yields at the short end of the curve, think 2 and 3 year bonds, have significantly sold off on the back of that. From our perspective, this has really increased the probability of a global recession through 2023, and certainly the slowdown that we're starting to witness in part of the data points we think is only going to pick up steam as we head through to the back end of the calendar year into the first quarter of next year. So whilst the US Fed has certainly been aggressive raising rates, the impact of those rate rises, as I said, has certainly been challenged right across the globe. And some central banks, particularly the Bank of Japan, as well as the Chinese PBOC, have sort of taken a divergent path, irrespective of the inflationary pressures that have been coming through. And that's actually resulted in the Japanese yen selling off to around about 145 to the US dollar. And over the month, we actually also saw the Chinese renminbi decline to 7 against the US dollar, so its lowest point since the middle part of 2020. In addition, the pound flirted with parity against the dollar over the course of the month as the revised budget of the new UK Trust government was released, and that was viewed very poorly by financial markets. In our view, the UK economy is in disarray, and this has been made worse by the state of politics in the country. And certainly the move by the pound, as well as obviously the sell-off in gilts, did require the Bank of England to step in to try and, as I said, ease the pressure on financial markets, as well as provide some liquidity into the market, which was clearly under pressure post that budget, the release of that budget. As I mentioned, the Chinese renminbi was sold off. The Chinese economy continues to stagnate, in our view, on the back of the challenges facing the short-term to medium growth outlook for China. This is hampered by rolling COVID lockdowns, the widening failure of the property market. And while the Chinese authorities certainly have sufficient means to salvage the property market, in our view, given the fact that it's such a key driver of economic activity, its failings is clearly impinging on the growth outlook for the economy, which continues to weaken heading through the back end of this year. With President Xi Jinping seeking a further third term at the upcoming People's Party Congress in October, the failings of the property sector and the disenchantment by many homeowners, in our view, does create a level of political risk that we haven't seen in China for some time. So it'll be very interesting to see how that the outcomes of that People's Party Congress and what it actually means for the policy footprint in China through to the back end of this year into 2023. In Eastern Europe, the war continues to go from bad to worse for Russia. We've obviously saw Ukrainian forces recapture significant swathes of occupied land as Russia really retreated back to more defensive lines throughout the course of the month. But however, from our perspective, though, the likelihood of Russia ramping up military operations continues, and we just see the risks of the war really being unabated at this point in time, and the near-term chance of any form of peace talks, in our view, is relatively slim. So that is going to continue to put pressure on geopolitical risks on a global basis. So against this backdrop, our asset allocation approach and the positioning of our portfolio really does remain focused on two key areas, and certainly focused to the downside risks that we're continuing to see in financial markets. The two key thematics that we're really building upon at the moment is maintaining an investment asset allocation that is suited to ongoing higher inflationary pressures. Even though we do expect inflation to moderate, we think it's going to remain well elevated north of central bank targets, and that's going to continue to result in central banks pushing rates higher, as well as obviously the impact of a stronger US dollar and what that then means for positioning in portfolios, particularly as it relates to global strategies across our portfolios. We continue to play that defensive theme through overweight positions in both alternatives as well as property and infrastructure, and the inclusion of real assets across our portfolios. And this is a theme that we've been chatting about for some time now, and as I said, it remains the core to our approach to managing to downside risk. And the second element associated with that, is maintaining a broad-based investment strategy across our core equity and bond positions. And within our equity positions, we continue to be underweight the Australian dollar, and increased our underweight to the Australian dollar, just given our outlook that we think it'll continue to depreciate further over the next 3 to 6 months. We believe, maintaining those core positions is important because it provides not only the diversification across the portfolio, but we can actually build into additional downside protection as opposed to simply moving into a higher cash environment. And the reason for that is that cash rates are still well below inflation, so we're really seeing a negative yield on cash at the moment. So we're not necessarily playing that defensive characteristics through higher cash allocations. Within our equity positions, we're remaining relatively neutral between domestic and global equities, but we're certainly maintaining that underweight position to the higher risk part of the market, whether it be small caps or emerging markets as relates to global equities. From our perspective, the need to adopt and maintain a flexible investment asset allocation process is going to be vital as we continue to navigate through what is very difficult periods for financial markets heading through to the back end of this year, and in our view unlikely to materially change through the first part of 2023. As always, if you have any queries about the portfolios, please feel free to reach out to anyone in the team, and we look forward to catching up again next month. Thanks, and bye for now.